Okay, picture a relatively quiet regional bank down in South Florida. You might drive past one of their branches and just assume it's, a sleepy local business. But what if I told you that in the first 3 months of 2026 alone, this community bank pulled in a massive $9.35 million in pure bottom-line net income? That is a serious jump from last year. Welcome to the EDGAR Brief. Our mission here is really simple. We take dense, accountant-heavy SEC filings and translate them into plain English. Today, we're cracking open the Q1 2026 10Q filing from USCB Financial Holdings, ticker USCB, to see exactly how they're printing that kind of cash.
But real quick, before we get into the actual numbers, a brief disclaimer. We are entirely independent, we're not affiliated with the SEC, and we are absolutely not financial advisors. We do use AI to help summarize these massive documents, so hey, errors can happen. Remember, this explainer is a translation of a public filing, not a recommendation to buy or sell anything. Always verify on sec.gov before making any money decisions.
All right, let's dive into this. Here is our roadmap for decoding the filing today. First, how USNGCB makes money. Second, the Q1 2026 scorecard. Third, assessing the defensive moat. Fourth, reading between the lines. Fifth, decoding the red flags. And finally, the bottom line. Starting right off with Section 1, how USCB makes money, understanding their business model. It's incredibly easy to get completely lost in the financial jargon of a bank's 10Q. You'll see talk of yields, basis points, capitalization ratios, the whole shebang. But if you strip all of that away, a community bank like US Century Bank is basically just a money rental business. Think about it. When you open a checking or savings account, you're essentially providing the bank with a highly sticky, recurring subscription. You give them your cash, and in return, they pay you a tiny fee, a very small interest rate. They then take your cash and rent it out to local businesses and home buyers at a much higher premium.
So the difference between what they charge the borrower and what they pay you, that's called the net interest margin. Honestly, think of it like the markup on a cup of coffee. You buy the beans for $1, you sell the brewed coffee for $5, and you keep the spread. For USCB, in this first quarter, they pulled in roughly $37 million in total interest income from their loans and investments, but they only paid out about $15 million in interest to their depositors. That leaves a massive, highly profitable spread before they even pay their staff or keep the lights on.
Let's move along to Section 2, the Q1 2026 scorecard. These are the cold, hard numbers that really matter.
Okay, so the absolute lifeblood of any bank is its deposits. If more dollars are walking in the door, the bank has more inventory to rent out, right? At the end of 2025, USECB had $2.34 billion in total deposits. Just 3 months later, by the end of March 2026, that number swelled to $2.49 billion. That means people and businesses gave them an additional $150 million of inventory to work with in just a single quarter.
Now, what's really interesting here is how efficiently they turned those deposits into real cash earnings. A year ago, in Q1 of 2025, they posted a net income of $7.65 million. Fast forward to this quarter, and they've jumped up to $9.35 million. That is nearly a $2 million year-over-year increase in bottom-line profit. And listen, this isn't some accounting fiction. This is real profitability driven directly by higher interest income.
Which brings us to Section 3, assessing the defensive moat. What actually protects them from the big guys? Look, strong profits naturally attract competition. So why can't a massive banking titan from Wall Street just swoop into South Florida and crush US Century Bank tomorrow? Well, we always look for durable advantages, things like exclusive licenses or high switching costs that act as a fortress around the business. And USCB has a very specific structural moat hidden in this filing. Their status as a Qualified Public Depository, or QPD, with the state of Florida. See, standard retail deposits from everyday people can be super flighty. You can literally move their checking account with a few taps on your phone. But QPD status? That's like owning an exclusive toll booth. It legally authorizes USCB to hold public funds from cities, municipalities, and the state government. You can't just set up a bank and do this. You absolutely need this specific regulatory clearance. And let me tell you, that exclusive status really pays off. As of March 31st, USCB holds over $220 million in these super sticky public funds. Now, to keep this awesome privilege, the bank has to pledge a portion of their high-quality investment bonds to the state as collateral. Specifically, they've pledged 20 bonds worth about $55.1 million just to secure this $228.8 million pile of public money. It's a brilliant way to lock in massive, stable deposits that bigger national banks might overlook or just not have the local relationships to capture.
Moving right into Section 4, reading between the lines,
Let's look at management's real strategy.
So now that we know they have the funds, where are they actually placing their biggest bets? When you hear bank, you probably think of home mortgages or car loans, but looking at their portfolio breakdown reveals exactly what kind of bank USCB really is. I mean, a staggering 56.4% of their entire loan book is tied up in commercial real estate. That is $1.25 billion rented out to commercial properties. Compare that to their residential real estate, which sits at just 15.5%. Make no mistake here, USCB is heavily tied to the success of the commercial property market in South Florida.
All right, Section 5, decoding the red flags. Basically, we need to ask, what could go wrong?
Because their commercial real estate exposure is so highly concentrated, what happens if that market takes a hit? We have to slice through the lawyer-speak boilerplate and look for the real risks in the filing. To do that, we look at their allowance for credit losses, or ACL. In plain English, the ACL is a legally required rainy day fund. It's literally money the bank puts in a lockbox just in case borrowers stop paying. This quarter, USCB bumped this defensive cash pile up to $26.1 million. That's a slight increase from the end of 2025, driven mostly by the overall growth in their loan portfolio. Management is literally taking cash out of their profits and setting it aside to build a buffer.
And honestly, they might just need that buffer. While the bank is highly profitable overall, we did find a pretty interesting red flag buried in the credit quality indicators. USCB has roughly $2.38 million in commercial real estate loans currently graded as substandard. Now, substandard, that is a harsh, red alert kind of regulatory term. It means the loan is inadequately protected, and there is a distinct possibility the bank will take a loss if things aren't corrected. Now, relative to their $1.25 billion commercial portfolio, $2.38 million is a tiny drop in the bucket. But in a concentrated portfolio, a few bad apples are exactly what you want to keep your eye on.
Which brings us to Section 6, the bottom line. Let's synthesize all of this into USCB's verdict.
So the absolutely crucial point is this. USCB Financial Holdings is a highly profitable money rental business with a fantastic deposit gathering moat in South Florida. But it is heavily exposed to the commercial real estate market. If you're following this company, here is exactly what you should track in their next quarter's filing. Number 1, keep a very close watch on those commercial real estate default rates and see if that substandard bucket grows past $2.3 million. Number 2, watch their QPD public fund deposits. If that $220 million shrinks, their moat might be cracking. And number 3, keep an eye on the allowance for credit losses. If management suddenly hikes up that rainy day fund, it means they're seeing storm clouds on the horizon. And that is your EDGAR brief on USCB Financial Holdings. We translated the numbers, but remember, this explainer was an independent analysis, not a recommendation to buy or sell. If these massive profit margins or big commercial real estate bets piqued your interest, head over to sec.gov to read the original filing for yourself. It certainly leaves you wondering if regional, specialized community banks might just be the surprise winners of the 2026 economy. Thanks so much for being with us here at the EDGAR Brief, and we'll see you in the next filing.